we've got these two things happening this time, just as they did in 1929 to 1932. You've got a credit bubble. And for those who, when you're in a credit bubble, you think everything's wonderful. Things are going up forever and it's nice and comfortable and, we're getting wealthier and, all this sort of stuff. I continue to buy the momentum stocks, not the value stocks, because who wants value when you can get momentum? So that basically is a credit bubble. And, if you find it hard to understand that, then look at the other side of credit, because for every credit, there is a debit. Or debt, and arguably we're in a debt bubble. Unarguably, therefore we are in a credit bubble. And furthermore, bank credit has been angled at puffing up asset values. If you look at the Nasdaq numbers, from FINRA for margin debt, that's now over $1 trillion. It's never been this high. It really hasn't. This debt bubble is the largest credit bubble, is the largest in history. The other great one, of course, which really undid everything, was the Roaring '20s. And when that ran into reality in round about September 1929, that basically collapsed the stock market in America by just under 90%. Almost wiping it out. The other thing we had then, of course, and you referred to it, is the Smoot-Hawley Tariff Act of 1930. And basically, that introduced extra tariffs on top of the Fordney-McCumber tariffs of 1921. And it was indiscriminatory. Basically, it wasn't just on consumer goods imported from other countries. It was from intermediate goods imported from other countries. It was also on commodities some commodities imported from other countries. And what have we got today? We've got exactly the same thing with Trump. We don't have a sort of Fordney-McCumber Act 10 years earlier. But you talk to people who've been advisors to Reagan and so on and so forth, who tried to roll these things back. Even under Reagan's time, Steve Hanke tells me that, we've had these tariffs have just been going along the whole time. So this is, if you like, Smoot-Hawley Mark II. And there is the additional problem. Back in 1930, the US economy was a lot more contained than it is now. By that I mean that the proportion of GDP which relies on imports far, far lower. We were talking about considerably less than 10%. Now, of course, it's a very different matter, and you've got supply chains all around the world. All those are basically being dismantled. You've also got the geopolitics, and this is something which of course, in the West, we're not aware of at all. We're just not interested in geopolitics. But the fact of the matter is that over 70% of the world's population is forming a line behind China and Russia. We can try and produce rules, regulations, tariffs, and all the rest of it against the rest of the world. But the rest of the world actually is moving away from us. And thank goodness. We're in self-destruct mode, whereas the rest of the world is going to be quite busy trying to protect itself from our follies.
Yeah.
The whole, I would say that the combination of this credit bubble plus Trump's tariffs, it's just absolutely unreal. I think it's worse than 1929. And on top of that, you've got another problem. And that is in 1929, we had a gold standard. In other words, even, whatever happened to banks going bust and all the rest of it, if you had physical dollars or you had dollars in a safe place, in a safe bank or whatever, then their value was guaranteed. So you had an escape, if you like, from collapsing asset values. This time, there's no escape. We don't have a gold standard. It just basically will collapse the currencies. So, we've got all these things happening at the same time. And one way of putting it is you could say that the fiat currency era is coming to an end. It's the death throes of the fiat currency system. Because what do fiat currencies do? It allows governments to do things to excess. You can't do that forever.
Yeah. And because of the crisis in 29, 30, 31, a lot of Americans decided to exchange their dollars for gold, right? Which eventually led to Roosevelt making it illegal for people to own gold in 33, 34.
Yeah.
Is something like that going to happen as well, you think?
Well, I'll take a rain check on that. I wouldn't rule it out, really on the basis that politicians are not driven by common sense. They're driven, if you like, by what the electorate demands of them. And, when you see some people getting rich in gold and silver, it would be wrong to say that even the most sensible politician would not be tempted to do something about it. So we wait and see.
We'll park that
If they do it, I tell you, gold and silver will be bid only, which is market jargon for there will be none available. And if you want to get any on the black market, whoa, it's up, 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 up. And you probably won't get it anyway. So, the answer is that you've got to have your gold and silver long before that. But there is another aspect to this, which I haven't yet mentioned, and I think we should throw into the pot. And that is, with the end of this fiat currency era, we're also beginning to see the end of the derivative era, which has built up particularly since the 1980s. That I don't think anyone is really seriously looking at. But if you see now, we've had, particularly in metals and commodities generally, the demand for commodities and precious metals has really been from Asia, from the dynamic economies, rather than ours. We have been sellers, and what we have done is we've tried to suppress prices basically by increasing artificial supply in the form of derivatives. We now have a situation where, China in particular has benefited from this. We've suppressed the prices so that China has been able to buy these commodities cheaply. What she has done is she has accumulated inventory. She didn't tell us that she's accumulated huge quantities of silver, gold, platinum, palladium, copper, whatever. But she has. And in the past, she's been perfectly prepared to feed a bit of it into the market to try and stabilize prices. And this is particularly the case with silver. Now what's happening is she's no longer doing that. She sees the end of the fiat currency system, and she doesn't want to part with her stocks of metals, which she actually needs, whether it's to, form basis of money in the case of gold, or whether it's for industrial purposes, particularly silver and copper and so on. She's hanging on to her stocks. So the liquidity, which the derivative markets depend on, the physical liquidity.
We are living in the death throes of the fiat currency era. And for many people, that sounds dramatic. They shrug and say, well, currencies have been fiat for 50 years now. Surely the system will muddle through. But the truth is that this system, this debt-driven, credit-bloated, government-managed illusion of prosperity, is unsustainable. It is mathematically doomed. And like every debt bubble before it, it will burst. The tragedy is that this time, the collapse will not simply be a correction in asset prices or a temporary banking crisis. It will be the failure of the currency itself. Because unlike in 1929, we no longer have the escape valve of a gold standard. Let us go back in time for a moment, because history doesn't repeat, but it does rhyme. The roaring 1920s were in essence a giant credit bubble. Banks lent recklessly. Speculators borrowed on margin to buy stocks, not because they believed in their intrinsic value, but because they believed the trend would never end. Momentum over value. Sound familiar? In fact, if you look at the margin debt data today, courtesy of FINRA, it is over $1 trillion. That's the highest level ever recorded by far. It is the textbook definition of a credit bubble. Back then, the trigger for the collapse was not only the bubble itself, but the infamous Smoot-Hawley Tariff Act of 1930. Protectionism choked off global trade, punished American consumers, and worsened the Great Depression. Fast forward to today, and what do we see? A replay. Donald Trump's tariff policies, call it Smoot-Hawley 2.0, if you will, are rolling back decades of trade liberalization. And unlike the 1930s, when America was relatively self-sufficient, today's U.S. economy is utterly dependent on global supply chains. Imports are not 10% of GDP anymore. They are critical arteries of production itself. Cutting them off with tariffs is like strangling yourself with your own belt. Now let me add another complication. In 1929, whatever chaos unfolded in banks or markets, The dollar itself was anchored to gold. If you managed to hold your savings in cash or gold coins, your purchasing power was preserved. You might have suffered from collapsing asset prices, but your money still held its value. Today, there is no such anchor. We live in an ocean of fiat currencies, unbacked by anything but government promises. When this bubble bursts, the collapse will not just be in asset prices, it will be in the currencies themselves. This is why I call it the death of the fiat era. Fiat currencies allow governments to do things to excess, to spend beyond their means, to wage endless wars, to buy votes with borrowed money. But as any family knows, you cannot live on credit forever. At some point, the bill comes due. And when the system is built entirely on credit, the crash is total. Let me put it bluntly. We are worse off today than in 1929. Then you had a credit bubble and tariffs. Today we have a credit bubble larger than anything in history, tariffs once again weaponized, and a currency system built entirely on faith. Faith, by the way, is evaporating. Look at global geopolitics. Over 70% of the world's population is aligning behind China and Russia. They are building alternative trade networks, alternative payment systems, and alternative reserves. The West, meanwhile, is sleepwalking into self-destruction, obsessed with short-term political theater, and blind to the tectonic shift occurring beneath their feet. Now you might ask, what about gold confiscation? After all, in 1933, Roosevelt banned private ownership of gold and forced Americans to turn it in. Could that happen again? My answer is, I wouldn't rule it out. Politicians are not driven by logic or morality. They are driven by expediency and envy. If they see ordinary citizens getting rich from gold and silver, while the broader public suffers, the temptation to intervene will be overwhelming. And let us be honest, how many politicians have the integrity to resist such temptation? Not many. But here's the critical point. If they do attempt confiscation, it will backfire. The moment the state tries to suppress private ownership, gold and silver will go bid only. That's market jargon, meaning there will be no sellers at any price. Availability will vanish. A black market will emerge. Prices will soar, and the state will expose its own weakness. The only protection is to own your gold and silver well before that point arrives.
Can you give me a little bit your vision on how the financial system globally will evolve after this massive crash that we are going to witness?
Yeah, I mean, I don't think we'll end up with the answer immediately. They'll probably go down a few rabbit holes and get it wrong. But the answer, actually, there's only one answer, and that is the legal one. The legal one in everybody's common law. And that is that you have to tie the value of credit to what is called corporeal money. In other words, money which actually exists with no counterparty risk. And that's only gold. So we have to get back onto gold standards, in effect, working gold standards, so that the value of credit, because gold doesn't circulate. I mean, you don't end up paying things except as the last resort do you actually part with gold. It's always credit. Credit has to be tied to gold. And that's where we've got to get back to. They'll go down, they won't get there immediately. I mean, we won't. I think there's a very strong possibility that China is planning to go in that direction. But this is a defensive move as far as China is concerned, because she won't want her currency, which will be central to the new world, if you like, the new world away from us. She doesn't want her currency to collapse with the dollar or anything. I mean, she's quite happy to run a fiat currency system while the world is in a fiat currency system. But, when the dollar really does tank, I mean, she's going to protect herself. And, it's a sensible policy, because if she was to do it now, she would be accused of collapsing our system. She doesn't want that. So, it's sort of collapse is underway first, then China protects herself with the gold standard. And Russia, incidentally. Russia can do it tomorrow. Russia, I think, probably wanted to do it yesterday. But, the Chinese have persuaded them to stay the hand. So that's what's going to happen. The rest of the world's going to go onto a gold standard via the yuan in particular, and any other currency goes. And I mean, China's already planning to do this. She's opening Shanghai Gold Exchange vaults in Hong Kong and Saudi Arabia. Why Saudi Arabia? Because of oil. It's an oil to yuan to gold exchange standard in the making. Hong Kong is the financial center, if you like, the offshore financial center for China's capital activities. So, yeah, I mean, you got those. I think she'll probably open vaults elsewhere. I mean, you may recall that when on April the 2nd, or just after April the 2nd, when Trump had his, all these boards with all these rates that he was getting, tariff rates that he was proposing. President Xi, the following week, went round all the, well, not all of them, but most of the ASEAN nations in the district, talking to Thailand, to Vietnam, to Cambodia, to, Malaysia and Indonesia, I guess, as well. And now we don't know what he was saying, but I think quite simply, he was saying, look, we've got to band together on this. Now, of course, you band together on trade. ASEAN being a free trade area, they will bring in particularly Japan and Korea, South Korea. You can talk trade, but then you've got to talk about a settlement currency. And it's plainly not good enough, for example, to accept Indonesian currency, which, is going down and down and down and down. Why would you want to take settlement in that? You don't.
When we left off, I said this is worse than 1929, and I meant it. The 1929 crash was brutal, but at least savers had one escape hatch: gold. Today, the fiat system has no such safety valve built into it. The collapse of credit this time drags the currencies with it. And this is why the next crisis is not just another market crash. It's the end of the fiat era itself. Let me walk you through how I believe this unfolds. The first stage is already underway. The credit bubble has peaked. We see it in record high margin debt, in speculative manias, in everything from AI stocks to meme coins. Insiders are selling. Jeff Bezos dumps billions in Amazon shares. Warren Buffett sits on $500 billion in cash. Nvidia's top shareholders quietly head for the exits. Meanwhile, the retail public is more heavily invested in equities than at any time in history, even more than during the dot-com bubble. That's always a tell. Insiders sell to the public at the top. At the same time, foreigners are dumping U.S. treasuries, China, Japan, Saudi Arabia. They are reducing exposure to American debt. And who supposedly picks up the slack? The Cayman Islands, Ireland, the United Kingdom, one of the most indebted countries in the world, apparently buying the debt of the most indebted country in the world. It's a shell game, plain and simple. Now combine this with the fiscal reality. Over $28 trillion in U.S. treasuries mature within 3 years. Against that, tax revenues are about $5 trillion a year. Add in $3 trillion per year in new deficits. You don't need to be a mathematician to see the problem. It's impossible. You can't fund that with real savings. You can only fund it with more printed money. And that's the essence of a soft default. You don't explicitly fail to pay. You debase the currency so thoroughly that the debt is paid back in worthless paper. How do they manage the optics of this? With tricks like stablecoin legislation, which channels demand into the front end of the treasury market. They use digital assets to prop up the short-term debt machine while the long end of the curve creaks under the weight of rising yields. Luke Gromen put it well. They want to anesthetize the back end of the bond market. In other words, keep savers drugged just long enough to roll the debt over. But there is no escape from arithmetic. At some point, rates on the long end rise because there simply aren't enough willing buyers. And here I think the playbook is already written. Judy Shelton, Trump's nominee for the Fed back in 2016, practically told us the plan. Issue long-term treasuries backed by gold, redeemable in gold at maturity. It sounds radical, but it's really a replay of what Roosevelt did in 1933, when he revalued gold from $20.67 to $35 an ounce. That gave the Treasury an instant windfall, a hidden tax on savers, and a way to fund New Deal spending. Imagine the same trick today. Gold at $2,500 is manageable, but if they revalue to $10,000, or even the $24,000 per ounce that Jim Rickards suggests, the Treasury General account gets trillions in free equity overnight. Every $4,000 rise in the official price of gold creates about $1 trillion in balance sheet gain. At $24,000, you've got $6 trillion to play with. And who suffers? Holders of dollars, savers, pensioners, anyone who trusted the system. This is why I say they will destroy the dollar to save the system. It's the only politically palatable path. You can't openly default on treasuries. You can't slash social security checks. But you can stealthily rob every saver by debasing the currency. That's the path of least resistance. Some viewers might ask, but Alasdair, won't they ban gold ownership again, like in 1933? I won't rule it out. Politicians are venal enough. But here's the difference. In 1933, Americans had no offshore options. Today, gold is global. It trades in Shanghai, Dubai, Moscow, Istanbul. Try banning it in one jurisdiction, and the market simply migrates elsewhere. What would happen is that official prices would freeze, black markets would thrive, and anyone who prepared in advance would be vindicated. Meanwhile, Asia is not waiting. Russia is about to launch physical gold trading on the St. Petersburg International Mercantile Exchange. They've already announced kilo and 12-kilo bars open to miners, refiners, banks, and industrial users. Their explicit goal is to set domestic price benchmarks independent of London and New York. China, for its part, continues to expand the Shanghai Gold Exchange, opening vaults in Hong Kong and even Saudi Arabia. Why Saudi? Because oil for yuan for gold is the new petrodollar alternative. It is an oil-to-gold exchange standard in the making. This is the quiet revolution, a shift from paper markets that trade 200 times more silver than exists for delivery, toward physical exchanges where supply and demand set the price. And once the credibility of Western benchmarks cracks, it's over. The COMEX and LBMA are already bleeding inventory. Month after month, we see net outflows. In some months, $8 to $10 billion worth of gold leaves the system. The insiders take possession, while the public is distracted by AI stocks. Now let's talk about silver. Silver is the joker in the deck. It is both money and industrial metal. It is essential for solar panels, electric vehicles, semiconductors, all the green transition technologies that governments are desperate to promote. Demand is soaring, yet supply is stagnant. And unlike gold, central banks don't hold silver in meaningful quantities. That means when investment demand collides with industrial demand, the market breaks. Rick Rule once described it as trying to siphon Hoover Dam through a garden hose. The pool of quality silver equities is tiny. When generalist investors wake up and decide they want exposure, there simply aren't enough vehicles. That's when you get the explosive moves. 50%, 100%, 200% gains in a matter of months. We've seen it before, and we'll see it again. Of course, there are myths to dispel. Some silver bugs fantasize about the mother of all short squeezes, where futures contracts force a total systemic breakdown. That won't happen. The banks control the exchanges. If delivery fails, they will cash settle. They'll change the rules, but make no mistake, the squeeze for metal is real. It just manifests differently. Higher premiums, longer delivery times, shortages of retail product. Ask anyone trying to buy 1,000-ounce bars for industrial use. The cracks are there. Now, some viewers might be wondering, what about digital currencies? What about CBDCs? Here's my view. Central bank digital currencies are not really about efficiency or innovation. They are about control. They allow the state to see every transaction, to enforce negative interest rates, to freeze accounts. In other words, they are the perfect tool for a failing system to tighten its grip. And make no mistake, they will try. But technology cuts both ways. Just as CBDCs can surveil, gold-backed stablecoins can liberate. Russia, China, even private consortia are experimenting with gold-linked tokens that can settle trade instantly across borders. Imagine choosing between a CBDC that tracks your social score and a gold-backed token that preserves value. Which would you trust? Here is where the geopolitical split becomes fatal for fiat. The West will push CBDCs, backed by nothing but state coercion. The East will quietly build trade settlement systems anchored to gold. Over time, markets will choose, and markets, when given a real choice, will always choose the harder money. It may take years, it may take a crisis or two, but the direction is clear. Let's pause for a moment and look at the social dimension. When currencies collapse, societies fracture, people look for scapegoats, politicians look for distractions, trade wars, foreign wars, emergency powers. These are the tools they reach for. That's why we must be prepared not just financially, but mentally. In times like these, the temptation is to chase fads, to panic, to react. But the better path is to stand firm in real values: honesty, thrift, productive work, and sound money. I often remind audiences, every fiat currency in history has failed. Every single one. The average lifespan is 50 years. The dollar went off gold in 1971. Do the math. We are overdue. What replaces it? Likely a messy transition, partial gold backing, regional trade blocks, multiple reserve assets. Perhaps the IMF tries to resurrect the SDR. Perhaps the BRICS launch a gold-linked trade unit. But ultimately, credit must once again be anchored to corporeal money. Real, tangible, counterparty-free money. And that means gold. Some might say, but Alasdair, isn't that too simple? Isn't the world too complex now? On the contrary, complexity is precisely why we need simplicity at the foundation. Credit can only function if it is trusted, and trust requires something beyond government promises. Trust requires gold. So what should viewers do? I'll repeat it plainly. Save in dollars and you will go broke. Position yourself in real money and you will not only survive, you may thrive. Own physical gold and silver. Store it outside the banking system. Diversify jurisdictions if you can. Think long-term. Don't worry about daily price moves. Worry about purchasing power across decades.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.